Thank you very much for coming today to our jointly hosted webinar on financing and sustainability of future-proofing aged care, and it's jointly hosted by the UNSW Aging Futures Institute and the ARC Centre of Excellence in Population Aging Research. Before we start, I'd like to acknowledge the traditional owners of the land where we meet. I'd like to show my respect and acknowledge that we're here today virtually on the land of the Gadigal and Bedigal people. That's where the university is, who are the traditional owners, traditional custodians of the land where this meeting takes place, and pay respect to elders past and present, and ask you to acknowledge the traditional owners of the land where you are, if you're located, wherever you're located today. So it gives me great pleasure to tell you a bit about the organisations and then introduce the chair today. So CEPAR is a unique collaboration between academia, government and industry, which is committed to delivering solutions to one of the greatest challenges of the 21st century, that's population ageing. And the UNSW Aging Futures Institute was established as an umbrella organisation to bring together all of the ageing research at UNSW. It's strongly interdisciplinary. And the chair of today's event is Scientia Professor John Piggott, AO, who's the director of CEPAR and a lead investigator on the Aging Futures Institute. I'll just tell you a little bit about John and then I'll pass over to John. So John is the Scientia Professor of Economics at the University of New South Wales. He's the former Australian Professorial Fellow, and he's published widely on issues in retirement and pension economics and finance, and in public finance more generally. And his research has appeared in the leading international economics and actuarial research journals. John worked with the Japanese government for nearly a decade, from 1999 on pension and population ageing issues. And from 2008 to 10, he was visiting scholar at the Wharton School of Business. And in 2018, he was awarded a Rockefeller residency to undertake research into ageing and inequality in Asia. In 2019, John was appointed co-chair of the Think 20, that's the T20, Task Force on Aging Populations during Japan's G20 presidency. And he is currently a commissioner on the US National Academy of Medicine's International Commission on Healthy Longevity. He jointly led the establishment of the International Pension Research Association, which was launched at the OECD in Paris in 2019. And at a national level, he was a member of both the Henry Tax Review and the Australian Ministerial Superannuation Advisory Committee for 5 years from 2007. So he's very eminent, and in 2020, John was appointed an Officer of the Order of Australia for contributions to population ageing research and public policy development. So I'll hand over to you now, John.
Thanks very much, Kaarin, and thank you for that very kind introduction. I think today's webinar is going to be really interesting. There has been relatively little feedback since the Royal Commission on questions of funding. There have been reactions in other domains like the quality of care and so forth, but not so far much on funding. And yet funding is going to be very central if this is going to be done well in Australia and done sustainably in Australia. I don't think there are easy answers to the funding of aged care, and I think that's reflected in the heterogeneity of systems that we observe around the world. And so we are very fortunate today to have two excellent speakers to give us perspectives on this issue. Mike Sherris and Hazel Bateman. Both are CEPAR CIs, Chief Investigators, and both are investigators with the Aging Futures Institute. What I will do, I think, is just begin with a couple of housekeeping issues, and then I will introduce Mike. Mike will speak for 20 minutes. Then I will introduce Hazel. Hazel will speak for 20 minutes, and then we'll have 20 minutes at the end for Q&A, or maybe a quarter of an hour for Q&A at the end. So the housekeeping issues are these. When the presenter is speaking, could you please keep your microphone muted? If you have questions or comments, could you ask in the chat box? We can do hands and stuff at the end if necessary, but chat box is a way in which we can keep things organized if there are a lot of questions. So they're the sort of big stories. And then as well as that, I need to inform you that the webinar will be recorded. The recording will be shared over the next weeks with all registered attendees. So with that, let me introduce our first speaker, Mike Sherris. Mike is I regard him as a kind of national treasure. He's an outstanding actuary. He was Actuary of the Year in Australia in 2007. He has been a member of a large number of professional and academic boards and organizations and initiatives, too numerous to mention. He came to UNSW in the 90s to set up an actuarial school, and he did that with so professionally and with such high quality that in the last few years, there was an independent assessment of all the actuarial schools in the world, covering, I think, much of the decade of the teens from 2012 to 2018, something like that. And the UNSW School of Actuarial Studies was first in the world. So Mike is an extraordinary guy, and we're very fortunate to have him here today. He's going to talk on financing and sustainability of future-proofing aged care. Let me turn it over to Mike. Thank you.
Okay, thanks, John, for your generous introduction. I'll just summarize some of the things that I'm going to briefly talk about. In a 20-minute talk, I'm going to talk some high-level issues, but firstly, I'll just talk about sustainability from a financial perspective on the background of the Aged Care Royal Commission, talk about some of the recommendations in the Aged Care Royal Commission into aged care quality. And then I'll talk a little bit about some of the research that we've been doing at CEPAR. So at CEPAR, the research isn't specifically around aged care. The actuarial research that I've been leading at CEPAR is around financing risks and financing retirement. So part of that has been looking at functional disability, long-term care insurance, as well as equity release products. So I'll talk a little bit about that from the perspective of the research that we've been doing at CEPAR, and I'll summarise that towards the end. So just on sustainability issues, I guess we're well aware of the aged care situation in Australia, given the recent Aged Care Commission, Royal Commission. So forecasting out into the future, there's an ageing population, so we see expected increases in aged care costs as the baby boomers go through older ages in retirement. There's recommendations in the Royal Commission to improve levels of home care, high quality in terms of care. This costs more money. Improve levels of staffing in residential care to improve quality. Eliminating waiting time. So one of the issues has been rationing of government funding to aged care, and that results in waiting time for things like home care packages. Then the need for indexing costs in terms of inflation, higher staffing costs. These are not automatically funded, so they put pressure on the sustainability of the system. And also we'll see and are seeing preferences for ageing in place and more support in the packages to fund people ageing in place. And when we look at the providers of aged care, various forms of them, many suffer issues around their sustainability in terms of their financial sustainability. So there are many pressures that the aged care financing system faces in its sustainability. And there are lessons to be learned from overseas. We saw that in terms of the Royal Commission. Some of the papers looked at some of these issues, and there were witnesses that describe some of the issues. And just taking two, for example, they are very similar to what we see in Australia in terms of the pressures from financing aged care. So in the Dutch system, we saw rationing, increased waiting times, deterioration of quality in terms of not having sufficient financing. And the Japanese system also had to respond to similar pressures. So there were introductions of mandatory contributions similar to the aged care levy proposed by the Royal Commission, increased co-payments as well, rather than reductions in co-payments. So these systems overseas have some lessons in terms of how funding aged care can be made more sustainable. And then if you have a look at, say, some of the quantification of these costs in the Deloitte's modelling for the Aged Care Royal Commission, they, for example, looked at if the changes that were suggested in the Royal Commission were implemented to increase the quality, then there would be a significant increase in terms of the funding required in terms of gross domestic product. Then just more specifically at the recommendations of the Royal Commission, I've selected just a few just to highlight the issues around sustainability of financing. So for example, funding for aged care is insufficient, insecure and subject to fiscal priorities of the Australian government of the day. One of the things that the Aged Care Royal Commission did recommend was that aged care, high quality aged care would be a universal entitlement. And they saw the reductions or removal of co-payments and means testing payments by individuals when they were receiving aged care, something that we haven't seen happen overseas. And that would put further pressures in terms of sustainability of financing. And the longer term financing recommendations from the Royal Commission around investigation of an aged care levy, indexing costs and other changes, including the means test, were not recommended by the government. And so these issues of sustainability still remain to be considered in effect. But the government did respond in the federal budget, increasing its funding fairly significantly, but not enough to cover the underfunding, if you like, that exists in the current system in terms of, for example, home care packages and so on. But there was a significant, very significant package, proposal of 17.7 billion going towards aged care. So it just shows the size of the budget requirements for aged care and how these will grow in the future, and that the issues around sustainability are important. One of the things that stood out for me in terms of the final report was Commissioner Piggot's recommendations, and he actually tried to do a little bit of an actuarial analysis to quantify the costs in terms of an increase in tax levy, and that really showed how significant the costs could be. But he acknowledged the need for some actuarial based analysis to assess the costs and to ensure sufficient funding would be available. He did recommend a aged care funding levy, aged care levy, and a particular way of funding it, and the idea of using actuarial principles and the need for an aged care fund actuary. So looking at more of a social insurance or an insurance-based setup, but the idea of doing more careful actuarial analysis and modelling to look at the sustainability is quite an important point, I think, that he mentions in his report, his recommendations, and something that I think still needs to be done. Yeah, so in terms of, if you wanted to look more carefully at sustainability, there's a whole bunch of issues and some things that I think stand out in terms of issues in the Royal Commission report. The way of determining benefits and funding benefits, an integrated model, that was one of the recommendations that I think was accepted by the government in integrating home support, home care and residential care. And as we've seen, I mentioned the overseas experience, co-payments are an important aspect in terms of the sustainability. It also has benefits in terms of an insurance perspective, limiting moral hazard issues. Of course, that's managed with means testing arrangements, which need a more careful look at in terms of how they operate. It's quite complicated, doesn't really align with the age pension means testing, so that needs a more careful look at in terms of the equitability and sustainability of co-payments. Integration with retirement income and health financing, the aged care does need to integrate, it does use age pensions to help fund the costs required in residential care, for example, and also obviously has to integrate with health financing. Introducing levies and co-payments, changing co-payments raises intergenerational equity issues. And so that needs to be considered if extra funding is brought in through a levy or changes made to co-payments. How do you balance up that intergenerational equity? And it's something that needs a much more careful look at in terms of sustainability. That should be looked at through some kind of actuarial-based funding and then some review of those funding arrangements. And in a sustainable scheme where individuals are contributing in terms of co-payments or through other means, there's a role for private market insurance and financing mechanisms, for example, long-term care insurance and perhaps equity release products. So one of the aspects, I think, from an actuarial perspective, it's not only looking at the long-run expected costs and financing arrangements, it's looking at resilience, looking at equity, it's looking at resilience to shocks, actuarial shocks in rates of disability, mortality, demographic changes, and also economic risks. So in terms of long-term care insurance, if individuals are making contributions, the time they become disabled, on average, it might be in their late 80s, mid 80s, and you're looking at in your 60s, retiring and looking ahead to finance it, there is a role for long-term care insurance, even prior to retirement. So it can fund things like co-payments in advance, pre-fund, and also share the risk in the insurance arrangement. This also includes payments for residential care, living costs, even residential costs, additional other costs. So if you know these costs in advance, then you can design some kind of pre-funding or insuring scheme that's more effective at meeting these costs. In terms of private products in long-term care insurance, there are some issues that limit its use by individuals. For example, there's health underwriting requirements. You have to be in good health to purchase these kinds of products. The triggers on these products aren't necessarily aligned with the aged care requirements of the government, so they're typically based on a certain number of difficulties in ADLs or cognitive decline, and there are some other aspects of these products but they still can be used in terms of funding these kinds of costs. So in terms of their usefulness, there's a group of individuals who would benefit from these, typically middle level wealth in good health individuals. Those that are not in good health, less wealthy, aren't going to be able to afford the premiums, or they're not going to qualify for those products. There's some of the issues around providing these products. Long-term care insurance, for example, are the frictional costs. These consist of the actual costs of arranging the pool and regulatory costs for insurers giving guarantees. They have capital costs, and these capital costs increase the price of these insurance products. And they're mainly there, these capital, to absorb systematic risks. So these risks that impact individuals all to a greater or lesser extent, and the benefits to a greater or lesser extent. So things like increases in longevity, increases in time spent disabled, inflation, and so on. These are systematic risks that somehow have to be more carefully looked at in the design of an insurance product. And the result of those systematic factors are loading. So we know that, for example, in guaranteed life annuities, loadings might be 10 to 15%. Half of that might be the capital costs to give guarantees. Long-term care insurance could be 30 to 40%. Once again, a significant proportion of that in terms of providing solvency guarantees in the products. So how do you make these products more effective? And there are different ways of doing it. Some are being looked at for life annuities in Australia, and these are mutual risk-sharing pools. So we have mutual risk-sharing annuities being looked at as a way of providing retirement income. These can also be designed for long-term care insurance, mutual risk-sharing long-term care insurance, which can have a very significant reduction in terms of the cost. And also these insurance products benefit from economies of scale rather than many small providers. So some of the innovations that are potentially possible in the Australian market, we don't have long-term care insurance. So actually having long-term care insurance providing some kind of cash benefits would be an innovation in itself. Long-term care insurance riders that are added to an existing insurance policy or an existing annuity add value. And for example, aged care annuities, quite popular in some countries overseas, combining a life annuity with higher payments when you become functionally disabled. These products have benefits in terms of reductions in capital costs and broadening the individuals who can actually buy the products in terms of health underwriting. Variable annuities, where the payments can be linked to some kind of investment return, equities, for example. These can be structured to provide long-term care benefits when individuals become disabled, requiring care up to certain multiples of how much is invested in the product. Joint life products are obviously very important in terms of cost and meeting couples' needs, and also, as I mentioned, mutual pool long-term care insurance. So the other thing is equity release products. We know that particularly the current retiring generations have a fair amount of their assets in their home equity, and assets tests favour home equity. So we see individuals wanting and holding significant amounts in home equity. Now, this does provide a hedge and insurance, if you like, against residential care costs. If you become disabled, then you can obviously fund residential care out of your home. So it is kind of an insurance already, some kind of long-term care insurance. And so it can potentially reduce the demand for long-term care insurance. But you may want to unlock the equity in your house to provide costs, cover costs for long-term care. Reverse mortgages is one way of doing that. So in Australia, very conservative loan-to-value ratios. So limited risk in terms of these no negative equity guarantees. There are obviously different structures. You can either take a lump sum or receive income. There are certain product provider risks and capital requirements. For example, if a bank is offering these and they have twice the capital requirements of a normal home loan, increasing the interest rate that would be charged, and there are other factors that impact the interest rate as well. So the interest rate can be higher than you might expect. The other way is unlocking through home reversions. And now the issue here is that if a bank does this, then they're holding residential home equity on their balance sheet, and that's very expensive in terms of capital costs. So you want to somehow get it off the balance sheet if you want to offer these products. So you want to try and securitize it some way. So some of the innovations around using reverse mortgages, for example, using a reverse mortgage to provide a life annuity or long-term care insurance. So if you want to fund long-term care insurance, you have an asset, but you don't have the cash to pay the premium, then using a reverse mortgage could be an effective way to do that. The other way you might think about a reverse mortgage is something like a deferred equity release product, which is triggered by, if you've got a couple, the first life moving into residential care, paid as some kind of indexed annuity. So this hedges your risk moving into long-term care and funding it out of your home. And the other way is home reversion. Superannuation funds, if they're able to offer home reversions, could easily create an asset class that members could invest their funds into, called residential equity. And that gets around the securitisation issue. So time is pretty much up for what I really wanted to talk about. In the slides, you can have a look at it. I've provided a little bit of a summary of the actuarial longevity risk research at CEPAR around modelling the risks that I've just spoke about from an actuarial perspective, long-term care insurance, design of the products, pricing of the products, modelling the risks, and also equity release. So I'm not going to go through a few slides I had remaining. I thought I'd stop there. Over to you, John.
Thank you very much, Mike. That was extraordinarily comprehensive, given you only had 20 minutes. Thank you. Now it's my pleasure to introduce Hazel Bateman. So Hazel is Professor in the School of Actuarial Studies at the University of New South Wales. She's had a whole career, really. Her academic career has been largely devoted to the question of pensions and retirement resources. And she is very distinguished. It's interesting to note that before she began her academic career, she was moving rapidly up the ladder in the Commonwealth Treasury. And I was the unwitting beneficiary of her husband's decision to move to Sydney and take up a position with one of the banks here. she came to, and she's been with UNSW ever since. She holds a number of, the work that she does, which is around what people think about different retirement products, what their attitudes are, how you can convey risk in a meaningful way to people, that kind of thing, I think resonates both with policymakers, with bodies such as ASIC, and also with business. And so she is in demand from both those quarters as a result. And it's extremely important work as more and more of these decisions move into the private sector, into the household, and away from just more or less blunt government coverage. Amongst her international appointments, she is the inaugural president of the National Pension Research Association. She has many other accolades, but I might leave it there and turn the chair over to her. She will be speaking on a new retirement product concerned with informal aged care.
Okay, thank you very much, John. Thank you for reminding me of my Treasury history. One of the nice things about not being in Treasury these days is to be able to criticise things that come out of Canberra. But anyway, so I'm going to be talking about something which was mentioned in Mike's talk. So Mike mentioned the possibility of private insurance products for long-term care. And I think this is something that didn't get a lot of profile in the Royal Commission. But a private insurance product for long-term care is something that can both assist with the financing of long-term care, but also improve the functioning of the retirement income system as well. So in my short time available, I'm going to talk about three main things. First, a little bit of background. Second, I'm going to present some work that we did a few years ago where we did a stated preference study for what we call flexible long-term aged care insurance. And then I'll make some concluding comments. So just some stylised facts to begin with. We know that we have a great retirement income system, but people are reluctant to draw down their retirement savings as well as other household assets such as housing to finance retirement. And so this compromises people's financial well-being in retirement, and that was well stated in the Retirement Income Review. But we also know that people have a preference for ageing in place and informal care. And so what that means is we have a large number of informal carers in Australia. According to the SDAC data, about 400,000 informal carers of the elderly, and that's around 10% of the over 65 population. And these are mostly spouses and daughters, probably female spouses. And this compromises the labour market participation and retirement savings and the mental health of this particular group. And then I guess our third stylised fact is we don't have private long-term care insurance in Australia. And just to sort of emphasise my first point, we did a study a few years ago, which was another stated choice study. And what we asked people to do was to choose spending trajectories in retirement. So whether their spending trajectories were going to draw down their wealth, leave their wealth flat, or build up their wealth. And associated with these tasks, we asked people to justify their choices. So why have you chosen to build up your wealth? We did this for Australian participants and Dutch participants. We have quite different aged care systems and retirement income systems in Australia and the Netherlands. And in both countries, the second most important reason after I need to spend now as well as later were future health and aged care expenses. And these results are quite robust. We've done these studies a number of times. And so health and aged care expenses are one of the key reasons why Australians are not drawing down their retirement savings. It was very interesting with the Dutch because they have the most generous public aged care system in the OECD, and yet the Dutch also continue to save in retirement and also say it's largely due to aged care expenses. So I guess we have issues with both our retirement income system, people are not drawing down enough, but also our aged care system, we have issues financing aged care. So what I want to do in the substantive, probably 10 minutes that I have left, is to talk about a study that we did, stated choice study of a potential aged care insurance product. And this could be a solution to both the effectiveness of the retirement income system and funding long-term care. And this is one of the products that Mike was mentioning in his talk. So think of a product where there's a single premium at purchase, and you could use your super, you could use housing assets, you could use a pension loan scheme. In our particular study, we assume people use their superannuation. And then this product will pay payments contingent on not satisfying, for example, not satisfying a number of ADLs or being cognitive impaired. And this product will pay a regular income in the period of need. Now, because this isn't an expense reimbursement product, this is a product that just pays when you need, you can use this product to pay for formal care or informal care. So you have discretion how to use the product, and you could use it to reimburse informal carers. Now, you have the potential to bundle this with life annuities, as Mike mentioned as well, into a life care annuity. Work that we've done at CEPAR and also that Mike's done at CEPAR has shown that life cycle models show that access to these sorts of products are welfare improving. And it is an emerging product in the US. So, for example, one of the most common annuities these days is an annuity with a long-term care rider. So this is a product that is potentially useful for people to fund aged care in retirement. It potentially can help address the informal care issue, where people are having to leave work, have lower retirement savings, etc. Okay. So we ran a stated choice study to explore the demand for this product. And our key questions were, what's the stated demand, who would buy the product, and how much would they buy? We also wanted to know whether if people had access to this product, it would release the precautionary savings that they currently set aside for long-term care. Would it release the precautionary savings and actually increase people's purchases of longevity insurance? We did this, an online study with a representative sample of 1,000 Australians aged 55 to 64. And what we asked them to do was to allocate their retirement savings across 3 products: an annuity, this aged care insurance product that I've just introduced, and an account-based pension. And so we designed a sequence of choice tasks to elicit people's preferred allocation to these 3 products. And then, because it's an online survey, we could collect lots of information about people. So we collected their demographics, their objective and subjective measures of exposure to risk, preferences, time, risk, bequest preferences, their product knowledge, demographics, home ownership, etc., a whole range of things. Now, obviously, this is an online experiment. We don't have much time. We are introducing people to products they don't know very much about or that they've probably never heard about. So we spend a lot of time in these experiments teaching people about the products. So in this particular experiment, we taught people about the risks they may face in retirement and the fact that there's aged care risks and aged care expenses. So as you can see here, we told people about the chance of needing aged care, that 3 out of 5 people could need some form of care during their lives. And we told them something about the costs. Now, this study was done a couple of years ago, so the costs are probably higher, but we told people that the cost could be less than $1,000 for basic home support to around $65,000 a year for residential aged care. We also taught people about the products and we incentivized them to learn about the products. So in these surveys, people get paid to participate, and people got paid on the basis of a quiz, which they took after they'd done the experiment on their understanding of the products. We also allocated people into 4 different wealth groups. So we collected information on their wealth as they came into the experiment, and we put them into 4 different groups. So the numbers they saw in the experimental tasks were somewhat similar to their own circumstances. Now, I do understand that in the real world, there are age pension means tests, aged care means tests and caps, and taxation. For the purpose of this experiment, we ignored all of those things. So we assumed that everybody got a flat rate age pension. Now, obviously, the next steps of this sort of study is to make these things more realistic and apply means tests and taxation to these choices. Okay, and even though it may seem complicated, at the end of the survey, we asked people the extent to which they understood what they'd been asked to do, and only 5% of our participants said they mostly or completely didn't understand. So people came into our experiment or our stated choice task, and we taught them about the products. We taught them about the risks they may face in retirement in terms of aged care. And then we asked them to complete a number of tasks. And I just want to give you one screenshot of the key task. So what we asked people to do was to choose the amount of aged care income they would prefer. So this product you would buy with your retirement savings, and you're choosing how much of this product you would buy. Now, because we were asking a three-way allocation between an aged care income product and then a life annuity and an account-based pension, we actually conducted a sequence of questions where we gave people fixed amounts of life annuity in each question. And then we asked a number of questions to elicit their most preferred allocation. And so what we got out of the experiment was people's most preferred allocation of their retirement savings to this aged care income product, whether they wanted it and how much they wanted, to an annuity and to an account-based pension. So just summarising some of our high-level results. So of our sample of a representative sample of 1,000 people, we found that around 75% of the sample would choose to buy some of this long-term care insurance. And the median amount they would choose was around $45,000. So this is suggesting that if they chose this product, they thought they would use it for high-level care, not just for low-cost things, but actually high-level care. And because we thought that this product might be attractive to people who would like to use informal care, to stay at home and use informal care, we asked a number of questions about whether people preferred that sort of care and whether they had access to the care. So we found that 70% of our sample reported that they had access to low-level care and 50% high-level care, and 50% of our sample would prefer to receive their high-level care at home from informal sources. And so this is sort of the market that we would have for this product. Okay. We then did estimated some regression models, and what we were estimating was the probability that someone would purchase this long-term care product, and also the amount that they would purchase. And we collected a whole range of variables, so I'm just going to report some of the key results. And one of the key results is objective measures of exposure to long-term care risk. And these were mostly not significantly associated with either whether people would buy the product or how much of the product they would buy. Only for females, because the product here was more expensive, because the products were actuarially fairly priced. Probably if we did this again, we could improve our pricing using some of the modelling that Mike's team has generated. So females were less interested in the product, but the product was more expensive. And interestingly, smokers were also less interested in the product. When we looked at some of the other variables, so the subjective measures of exposure to long-term care risk, interestingly, when people self-assess chance of needing residential care, so high-level care, people whose self-assessed probability was lower than average were less interested in the product, but people whose probability was higher than average were more interested in the product, and they would set aside money for it. We also asked people if they were aware of long-term care risk, and outside of the experiment, whether they'd set aside money previously in the real world to fund long-term care. And we found for these people, they would, conditional on purchase, they would buy significantly more of the product. Okay. Now, turning to the impact of this product on people who may be interested in using informal care. So people have access to and interest in using informal care. And we found here, we think these results are particularly important, particularly interesting. So people who had available to them informal care for high-level care were more interested in buying the product and would buy more of it. You know, so for example, interpreting some of the results here, males and females who have access to high-level informal care demanded 25 to 37% more aged care income than those who didn't. And this was particularly strong for females and also for females with children. And so, you know, we see this is almost our target market here. Females realise that they live longer than males, and they're most likely going to be looking at informal care from their children. And here we see that having the number of children also increases the amount that females would buy of this product. We also asked people about bequests, and where people had a bequest motive, or when females have a bequest motive, the demand was slightly lower. Okay, so we see that this product, there's high demand for this product, and there's particularly high demand for this product for people who have access to and would like to use informal care. The second part of our study, we wanted to look at whether access to this product would release precautionary savings for the purchase of longevity insurance. And so we asked a series of questions to help us work out whether annuities and our long-term care insurance product were complements or substitutes. And we found for a large minority of our sample, these products were actually complements. And so once people had access to this aged care insurance product, in our stated choice experiment, that would release precautionary savings and increase their demand for longevity insurance. And this was particularly so for the group who had low perceived aged care risk, which suggests to us that a life care annuity, as Mike mentioned earlier in his talk, would be an effective product due to risk pooling. Okay, so what have we found with our study? We found that there's multiple benefits both for long-term care financing and the effectiveness of retirement income from offering a product such as this. There's strong stated demand for people who prefer informal care and want to compensate their carers, particularly females. Access to this product releases precautionary savings set aside for future care costs, and I showed you from previous studies that both Dutch and Australians, key reasons why they hang on to their savings is to fund aged care. There's also a larger potential market for this sort of product than the expense reimbursement products overseas. So we know that many products overseas are poorly designed for a start. We wouldn't want to introduce them here. But also one of the reasons why people don't buy these products overseas is they would prefer to use informal care, and these products don't pay or reimburse for informal care. And so there's a larger potential market than we see in products overseas. Finally, just some practical implications of these products. Now, obviously, these products only cover partial costs because they're not expense reimbursement. But in combination with public financing, they can produce more effective financing of aged care. There's also, if these products did exist, there'd be the behavioural barriers to drawing down assets to buy these products that we see with many other products. So people are not buying taking reverse mortgages, people are not buying annuities, largely because of behavioural reasons. People don't see those, for example, people don't see their house or their housing assets as something that they should use to fund aged care or perhaps fund retirement incomes. There's also the standard barriers that we see in the take-up of unfamiliar products. So life annuities is a typical example. People are not aware of the product, people don't understand the product, and there's issues in product distribution. So if this sort of long-term care product was marketed in Australia, a lot of care would have to be taken to overcome these barriers. We also have to assume here that people would spend the money. So we may get an elderly person to buy long-term care income insurance, but we'd have to encourage them to spend the money. And when we're thinking about giving income to older people, we also need to think about the efficacy of giving income to people who over time will develop cognitive limitations. So those are the key things I want to say. I also want to say that this is preliminary work. We did this work a couple of years ago, and we've been extending this work in recent times. So we've been looking at a case of buying this product with housing assets, and our preliminary results show that that would increase demand for the product. And in future work, we're looking at using the pension loan scheme to buy these sorts of products. So I've probably gone over time, John, but thank you very much, and I look forward to questions.
Thank you very much, Hazel. Very interesting presentation about a novel product. So we've got sort of two perspectives now. We've got a sort of an overall perspective and then a specific perspective from the perspective of a specific initiative. I do have some questions. I have two that were sent to us and I think were shared with Michael and Hazel before the session began. And then I have two others from Anna Howe, which are in the chat box. So perhaps we can start with the two that were sent to us in advance. There's one for Michael, and one that I think is sort of more Michael's territory, one that I think is more Hazel's territory. So to pick up maybe with Hazel initially, this question of reverse mortgage. This is from Lois Towett from UTS, and she points out that there is often a reluctance to use reverse mortgages, even though that's frequently focused on as a way of providing funds for expenses as people age and for aged care. I think that maybe we could start there with you, Hazel. And then the question for Mike, just to give him a little bit of advance notice, is from Palliative Care Australia, Camilla Rowland. And she asks, how will the delivery of end-of-life care, palliative care, factor into the aged care financing model?
Okay, so I'll start. So reverse mortgages are very interesting products and very useful products for those people who do have a lot of assets but low income in retirement. But as mentioned, the take-up is very low. And I think this shouldn't be interpreted as people not wanting these products. It should be interpreted as, well, some people don't want them, but to some extent interpreted as people not understanding the products. I think it's a similar case with all types of retirement income products, which are complex products, which people are not familiar with. There's no history of family or friends taking these products, and people just don't know about them. And it's very hard for people to learn about them. So I actually think as part, for example, of the retirement income review, of the retirement income covenant, giving guidance to people to understand, how to draw down the retirement savings, people need to be given guidance on the characteristics of these sorts of products and the benefits of these products to their sort of lifetime retirement benefits. But yeah, it's a challenging issue. Perhaps we know that the government has set aside $9 billion or something to promote the pension loan scheme. So perhaps the government in doing that is going to educate more people about the benefits of reverse mortgages.
Yeah, and I think that people are probably a little bit more comfortable borrowing from the government than they are on this basis than they are borrowing from a private provider. Mike, can I turn it to you now on palliative care?
Well, I guess only to say that in the Aged Care Royal Commission recommendations around the home care packages, there was coverage of palliative care and inclusion there. That was a recommendation accepted by the government. So it's something that they're aware of, and it's part of the financing that's being looked at. So obviously all these kinds of cares need to fit into this funding model, whether it be, the home support, home care, residential care, palliative care.
Right. Thank you. There's another question for you, Mike, I think. and it's from Anna Howe, and she's asking about, I guess, two related things. One is about where co-payments have been increased at the system level, where co-payments have been involved in countries like the Netherlands and Japan. How effective have they been? How much revenue have they raised? And what sort of happened as a result of those? And she also asks whether there's been much actuarial input into those countries and into other countries such as Germany. Is there any comparative actuarial analysis of systems which are already well established?
Okay, so, well, obviously, the co-payment has to be well designed, but it does contribute. And for example, in the Australian current system, about something like a quarter of costs, but it needs to be well designed in terms of how it integrates with the government provided benefits and what those payments are for. But it certainly does reduce costs. It does make, and also gives some flexibility as a demographic goes through, maybe larger or smaller, then those costs are larger and smaller, and that gets shared. So it does share those costs and risks. In overseas, if you're looking at social insurance type arrangements, they're typically actuarial involvement. It's basically an actuarial scheme. I mean, the aged care financing in Australia, it's a long-term care insurance scheme, public long-term care insurance scheme funded out of pay-as-you-go revenue. I'm surprised that there weren't more actuarial inputs and analysis in the Aged Care Royal Commission. There's very little assessment of possible models and costs and risks, and that would be an actuarial perspective that would have been, I think, valuable. So I was pretty surprised that there wasn't more input, and I would expect and hope that there would be in the future.
I know the Actuary Institute is doing some work on the Australian case. They're on aged care, and they've got a draft report already, not yet released. I have a pair of questions from Mark DeCure and Pip O'Keefe, and I will go to those next, I think. Mark asks, what are the presenters' thoughts on what needs to be done to encourage these long-term care and annuity products, and what's required to ensure they're available, tax or education awareness, risk capital? And Pip asks a related question, so I'll give that to you as well. Could you elaborate on what could or should be the role of government in these types of products? So what role should governments have in particular helping address some particular sorts of market failures which might exist in this space? Who wants to start? Someone has to start straight away.
Okay, well, there's going to be demand and supply side issues here. So there's going to be supply side issues, which I'll let Mike address. So how can we get providers to actually design, sell, market these products? But on the demand side, like all of these complex products, we have to work out how to facilitate people being aware of these products and understanding the benefit of these products. And I did notice another comment in the chat from David Bell about the role of, we talk about defaults or nudging people or defaults in retirement income products, annuity type products. So is there a role for something similar? And I'm asking the question back now, is there a role for something similar for these long-term care products? And I would imagine there would have to be some sort of recommendations, nudges, help by government, because these are complex products. People won't know about them. They won't know how they can benefit from them. They won't know where to buy them. So there's going to have to be some sort of government help there. I was wondering about the role of the superannuation industry, and I went back to the Retirement Income Covenant as I was preparing for this talk to see if there was mention of aged care or funding aged care, and there doesn't seem to be. But I'll let Mike address the supply side issues.
Mike.
Yeah, so I mean, there's various ways. Obviously, in the taxation and regulatory environment's important, and government has a big influence on that. So if it's, as we've seen for superannuation savings and so on, if it's tax favoured, then individuals are more motivated. So if it's regulatory and tax environment that's not conducive, then that's a problem. The other thing around these systematic risks, so you can design the products like I mentioned to reduce the costs of these systematic risks, but when they do occur, for example, very high inflation or whatever it happens to be, if it's quite significant, then individuals aren't, and individual insurance private market type products don't manage those risks very well. They can undermine the market. So some kind of, whatever the arrangement is, some kind of government reinsurance perhaps could be a way of kicking it off. Or I know, having governments offer these products isn't something that you would possibly see, but they're well placed to take on these risks. They obviously do already through the budget and financing aged care and pensions and so on. So, how do you encourage the private market? There may be a small cost initially with a large benefit in the future, and it's really a matter of quantifying that.
Yeah. I just want to add something else too. So we see with reverse mortgages, we have the government pension loan scheme. And in a way, that's a way of advertising to people in general that there's something like a reverse mortgage around. So, perhaps there could be a pension loan scheme product that's related to purchase of this sort of aged care insurance, which would be another way of sort of extending knowledge about the product more broadly.
Yeah. Yeah, I sort of have a view that with these very long-term contracts, contingent contracts, that people are a bit more comfortable with government provision, but I'm not convinced about that completely. I have that feeling. Look, there's time for one more question. For this one from David Williams, and it's kind of a comment, but maybe you could both just respond to that comment, and then we'll have to draw it to a close because we'll be out of time. His question is, if people were better informed about their aging and how to manage it well, wouldn't this benefit both the community with regard to costs and the person with regard to a shorter and less expensive outcome in aged care? In other words, it's really a question about healthy aging, I think, as much as anything. So I don't know whether either of you would have a response to that.
I would, well, one could say that it should be compulsory for everyone to complete something like My Longevity to better understand to actually better understand their longevity and and likely sort of health status as they age. Because on other branches of work that I have, we've sort of asked people how long they think they may live, and many people underestimate that for a start. So people have a
Yeah, I mean, I just make the comment that obviously it's important to be aware of these, and people don't know these kinds of risks, but it's not just about expected. You expect to spend 2.5 years in residential care. You expect to become disabled at 85. It's the range and variability around that that's important. Some people may become disabled at 70 or not disabled throughout their whole life, or they may be very severely disabled. They may suffer cognitive decline. There's a whole range, and understanding that range and being aware of the range. And that's why insurance, and highlighting the benefits of insurance, that there's a risk and it can handle that risk. Just talking about expected values isn't really useful.
Okay, look, we're going to have to leave it there. 2 o'clock has chimed. Thank you so much to the speakers, Hazel and Mike. Thank you also to Kaarin for initiating this joint webinar. And then we have a professional team. We have Louise Kelly and Dan Dumbrell from AFI, and we have, of course, Silke Weiss from CEPAR, without which this would not have happened. So thank you to you all. I hope everyone has found this a stimulating session. There were questions we couldn't get to, which are on the website and on the chat box. So thank you very much, and I must call it to a close there. So long. Thank you. Bye-bye.